Today, I'm going to talk about how non-qualified investment loans are booming in this current real estate market. This is very exciting for my fellow real estate investors. So let's dive deep into this. Let me share this article, and here's the headline. Why non-qualified loans are booming now. What I'm saying is non-qualified loans are DSCR. DSCR or debt service credit ratio. I know it's very technical, but there are a lot of savvy real estate investors out there who have purchased one or more investment properties in the past. And especially from my network and thousands of investor members that I've been working with over the years, this is very timely information to hear as you continue to scale your real estate portfolio and as your wealth start to exponentially increase. And thank you so much for many of you who has been working with me as your coach and mentor to help you continue to scale your real estate investment portfolio. Many of you know that that's the key. The key is buy as many properties as your motivation allow you to do, and as long as you have capital. Normally, the Fannie Mae lending guidelines, the traditional lending product, the most favorable terms out there, Fannie Mae, allow our investors to obtain up to 10 mortgages per person if you qualify, that is. They are full doc loans. They require high credit score, 720 or higher credit score, with a DTI, debt to income ratio, of typically around 45%. They are full doc loans, all right? They are the best type of financing in the investment loan market. And 10 mortgages, which is pretty good. If you continue to buy cash flow properties, that's the key. If you continue to buy cash flow properties, you should be able to fit in the box of qualify for the 10 mortgages. By the way, buying one single family rental property equal one loan. Buying a duplex also equal one loan. That's it. If you buy a triplex, a 3-unit investment property, that's one loan. So if you buy a fourplex, a quad, that's only one loan in the eyes of the Fannie Mae lending guidelines, 30-year fixed rate mortgage. This is truly an amazing traditional investment product for investors. So imagine if you have the extreme motivation that you can scale to, if you can buy 3 or 4-unit property with one loan, that's how you scale. If you have 10 max mortgages, you can buy several single-family home, several duplex, several triplex, fourplex. You just do the math, how many multiple doors you can purchase as an investor over time, that is. So anyway, but then again, somewhere along the way, you can run into challenges. Some of your property may not cash flow as high. Maybe your income situation whereby you're unable to qualify for the full doc traditional Fannie Mae investment loans. And then what are your options? And so many of you in that situation, if you're self-employed, for example, or all of a sudden you don't have a W-2 for whatever reason, and people who does not qualify under this full loan doc scenario, they can qualify for investors can qualify for DSCR loans. And DSCR loans are not a full doc loans. As long as you have good credit, very high FICO score, way above 700, as long as you have the down payment, require 25% down payment, the lenders, they look at your property to qualify, not your personal lack of W-2 income. You don't need that, or any other. You don't have to submit your tax returns or whatever documents. It's a no doc loan. I know some of you are thinking, oh, no doc loans, those are high risky loans that one of the reasons why the housing market in 2008 crashed because of all these subprime mortgages. No, DSCR loans is an investment product that the lenders use to collateral of the property, 25% down payment, as long as the property qualifies, like the property cash flow. If we have a rent to value ratio of 0.7% to 1%, that basically qualify. As long as you, what else? As long as you buy a property that qualifies, that the cash flow, that have the entry level, the purchase price, you can get cash flow at 25% down payment. That's mostly these kind of properties that qualify under DSCR or basically located in the Midwest and Southeast, when investment homes are much more affordable relative to the rent that are projected accordingly. Does it make sense? With that in mind, let's go ahead and share the information over here. There's a surge in demand. Who would think in this challenging market, all those negative headlines, all this doom and gloom, the economic uncertainty, the elevated mortgage rate, the skyrocketing of home prices over the past few years, and all recession talk, all this fake news about housing crash and this and that, and everything's all negative. But real estate investors are very smart. The savvy investors understand there are deals out there. It's not about the mortgage rate. Yeah, mortgage rate is just one component of buying an investment property. So if you're a rookie investor, please, as a matter of fact, you should subscribe to my channel free. If you put your email on my website below, so you can learn about real estate investing. If you're a newbie, we have a lot of steep learning curve. That's what we do in my network, the Year Real Estate Network. We provide free contents to our free members into your email every single week. So you can learn more about real estate investing, so you can do the things that many of my savvy investors have achieved at this point in time. So this DSCR loan product is a way for the industry to reward you, so you can get some good rates, good interest rate. The DSCR rates are a little bit higher than the traditional full doc loans, but not that much higher. The rates came down to a point where it's a very favorable interest rate. And some of the DSCR loans, depends which lender you go with, but some have a prepay penalty, or like a 2-year prepay. Some do not. It all depends. So you have to consult with your DSCR lender to go over what of this kind of loan product is appropriate to your situation. Of course, we have a list of the investment lenders. So I have to contact me if you wish to get one. For those of you who want to do a DSCR loan for your real estate investment, this kind of loan is surging. DSCR, debt service credit ratio. I know it's very technical. These are people who have alternative income documentation. This Housing Wire article just talk about this. The current market present a unique window of opportunity, especially for borrowers who fall outside the traditional lending guidelines, as I told you. So DSCR loans or second loans, home equity line of credit is HELOC. Home equity line of credit is part of the unique loan scenarios where you can obtain, especially as an investor. And so a second mortgage makes the most sense to protect the first low interest rate mortgage. It goes on to say homes across the U.S. are aging. There's a lot of older homes, but you may not know, in my network, I mostly promote newer construction homes in a fast-growing market that can cash flow. It's an amazing market that we're in, like in Texas, Oklahoma, and Florida, and Alabama, to name a few. Those are the markets we have for our investors. New constructions, which is amazing return if you follow my channel. All right, let me see. So real estate investors can obtain a DSCR, a second mortgage, for cash out to purchase. Now, have to be careful. What are you buying with this cash out refinance? What are you buying with this DSCR loan? So I will talk about that later on this presentation. Another reason is that there are an issue with the high debt balances. Now, I don't want my investors to enter this situation, but other homeowners who have some stress in their family, money issues, they may need to use a second loan to address those issues. The homeowners are cashing out to help with high balance credit cards, auto notes, and other debts to pay it off or to consolidate. Consumer credit card debt stands at an estimated $1.6 trillion, and automobile debt at $1.1 trillion. A closed-end second mortgage can bring relief and a way to achieve financial goals. Borrowers can turn to typically illiquid assets into cash they need. Now, this paragraph typically talk about the traditional homeowners, the owner-occupied primary homeowners who have a fair amount of equity for whatever reason, bad money management or circumstances beyond their control have run into a financial crisis, and they incur those dreaded bad debt, those credit card debt, which is a killer. I don't want my investors to be in that position, but if you are, or especially if you're a primary home buyer, you are in this situation. If you own a home, if your home have equity, you still have decent credit, you can qualify to get a second loan to get a home equity line of credit to pay off this dreaded consumer debts. Does it make sense? Hold on. Let's continue. Investors. Let's get back to investors. Investors and self-employed investor borrowers can be considered underserved if they cannot qualify for a traditional Fannie Mae investment loan. Typically, a traditional full-time borrower have very good W-2 income. They want easy loan that does not require income or employment documentation, such as a DSCR loan that qualifies on a cash flow of the subject property. So if you can find a property that can cash flow with 25% down payment, like I said, if you have good credit, if you have the down payment at least 25%, you can get a DSCR loan, just a slightly higher interest rate, not that much higher, you'd be surprised, than a traditional investment loan for someone who has full doc loan with a W-2. So the lender look at the property you're purchasing, not your financial paperwork, not your W-2, not your tax return. They don't need none of that. Isn't that cool? And still, it's a 30-year fixed rate mortgage, believe it or not. It's not an adjustable loan, the DSCR loan. So we don't know how much longer this product is available out there. A number of my savvy investors are using DSCR loans because for whatever reason, maybe their DTI, their debt to income ratio, is higher than 50% for whatever reason. I wish you. That's why some of you don't know what I mean by DTI, debt to income ratio. Even you can do a full doc loan as an investor if your debt to income ratio is higher than 50%. Quite often, many lenders will not allow you to get a full doc investment loan, even with 25% down payment. So the DSCR loan is a little bit riskier product, but it's not necessarily high risk because, again, the lender using your collateral, your 25% down payment collateral, if you were to default on your DSCR loan for whatever reason, and the lender can come back and then get a lien against your property and take that property away from you. That's the consequences of a default on any loan, let alone DSCR loan. It's a low risk product, the DSCR loans, but it's not as low risk as a traditional W-2 full doc loan with Fannie Mae lending guideline that we normally ideally want. Does it make sense? Today's market, with investors who have purchased several properties in the past, and they have a very good historically low rate on their investment loan mortgages, and they don't want to cash out refinance and get rid of their low historical rate. So it's understandable. So they need to get a line of credit if they have enough loan to value. If you have a loan to value LTV of around 50% or lower, you can some investors can get a HELOC loan from their existing investment property that they have achieved high equity position already. And many of our investors have done that, especially when you purchase those great properties during the pandemic housing boom several years back in Texas and Florida and a few other areas. My investors, your investment homes have appreciated amazingly in the past 4 to 5 years. It's a one-time historical opportunity that you're able to experience. Some of my investors' homes that you purchase in Central Texas and North Carolina and Florida, your equity have increased like 30, 40, 50, 60% in the past, during the housing, in the past 4 or 5 years. That's it. But those days are long gone. No more pandemic housing boom. Maybe. Who knows about the future? All right. So getting back to this loan. So many investors, They can cash out using the DSCR second and keep the first lien intact because there are 19 million investment properties in the U.S. currently, and there are 17 million self-employed people in the U.S. today. And because if you're self-employed, oftentimes you're not W-2, you have a Schedule C sole proprietorship tax return, and a lot of your Schedule C sole proprietorship, you report very little income because you write off so many expenses. And I'm one over the years. I have been a proprietor of Schedule C, and I write off so much expenses. The net income on the tax return shows so little money. Not anymore, but years ago when I did that, I had to get some alternative loans, just like what I'm talking about now. It's very hard for self-employed individuals to get financing these days. I'm sure many of you are watching this video can attest to that. So it's very challenging for lenders. But again, the DSCR loan is an opportunity for you to continue to scale your risk portfolio in this, because there's a lot of risk investors, especially savvy ones out there. There are still so many great deals out there, regardless of the elevated mortgage rate, regardless of all the negative headlines you've been hearing. There are opportunities out there to find some investment deals that can still cash flow, that can still have high appreciation potential, and etc. So if you're part of my network, if you watch my YouTube videos, if you're my free member of my network, you will understand the investment opportunities that comes into your email inbox about the things I just talked about. This negative headlines, it just spook a lot of rookie, unsophisticated people, unsophisticated people out there. But myself, as a coach, mentor, and experienced investors for past several decades, I am still buying rental properties under this current challenging housing environment, because investors, we know what's going on. We get the deals. Now it's a buyer's market, so there's a lack of competition out there. I get to negotiate, and my investors that work with me, we get to negotiate some great deals when we buy investment properties these days. Single-family homes, mainly single-family home residential investing, some duplex and fourplex that we have within our portfolio. All right, so let's conclude this situation. So there's still a lot of self-employed people out there who otherwise qualify, who otherwise have a good credit score, probably own a primary home as well. That's a nice way to qualify for the DSCR loans with some lenders. Some lenders does not require that you need to have a primary home, but it depends what DSCR lenders you go to. Again, come talk to me. I'll give you the resources for those lenders. A lot of these self-employed people who does not qualify for traditional full-out loans, they don't have the tax return is not attractive looking. They can use alternative documentation for these borrowers. And HELOC is another example. You can use DSCR loans to buy investment property with at least 25% down payment, good credit, and you have the capital requirement. And of course, you can get a HELOC. Investor, you can get a home equity line of credit from your primary home. If your primary home have enough equity, you can do that. Or if your investment property have a lot of equity, there are many lenders. If your equity position, if your loan to value LTV is 50% or lower, you might be able to get a HELOC from your primary home. Now, the whole presentation I'm talking to you about is if you're locked in to your traditional primary home with a historical low rate, 4%, 3%, whatever, as well as if you have existing investment properties that you have lock-in rate of 4% or 3%. Now that's a little bit different animal. Some of you still want to cash out refinance your investment properties, even with a low mortgage rate. As long as the numbers make sense, as long as the money you use to cash out refinance, you can buy some great deals out there that cash flow, and that cash flow can offset the cost of borrowing, the cost of the debt. So you have to work with a very savvy investment loan agent. We have those to crunch the numbers to determine if you were to get a HELOC from your primary or from your investment property. The goal is, what is the money for? If the money is to use to buy some shiny toys bad debt. No, that's not a good situation. As long as you use the money to good use, so the cash flow you can achieve by buying more properties from your DSCR loans or from your HELOC for that matter, can pay back the cost of borrowing. Does it make sense? So you have to run the numbers with your investment loan agent, a good one that is. All right, I think we can pretty much conclude everything. Anything else I need to say? I think that's pretty much it. I think that's pretty much conclude my presentation. Again, the recap is there's a lot of alternative loans out there giving this challenging housing environment for your savvy investors who have purchased several properties already, whether through my network or otherwise. If you have a lot of equity from your investment homes, you can buy more property. If you have more capital, you can buy a standalone DSCR product, debt service credit ratio, with a pretty decent rate, and you can cash flow as long as the property you're buying have cash flow potential. So you cannot buy a expensive single family home somewhere in the West that'll cost $400,000 or more. You're not going to qualify for a DSCR loan because the rent to price ratio does not make sense on a higher cost property. So ideally, when you do a DSCR loan, when the lender do the underwriting of the property, must meet the ratio, like I said earlier, 0.8% or even 1% debt to value ratio, the 1% rule. I know some of you are thinking, oh, there's no more 1% rule these days. Yes, there is. All right, that's all I have to say. Yep, at the end of the day, there's a lot of investment opportunities out there, but if you get able to get the proper type of financing, you can scale to buy more properties. If that's your goals, why not? Why not get more doors? The more doors you buy, the more properties you buy, using whatever leverage, the power of leverage in real estate is second to none. That's how you make your money. That's how you make your return over time. So scale your portfolio using various loan options available to you, in which HELOC and DSCR loans could be in your situation. I know everybody's different. Every investor have different goals, different objectives, different financial situations. But that's the beauty. There's a lot of way to work around a lot of scenarios. But at the end of the day, it's all about financial freedom. It's all about wealth building. In risk investors, you have a lot of options available to you. This is a great time to invest in real estate, regardless of what you hear, the doom and gloom out there. Negative news you've been hearing. You need to just trash those fake news out there. There's opportunities in a vast market out there. So anyway, thank you so much for watching. If you've received a lot of value from this video, please like and subscribe to my YouTube channel. And better yet, put your email into my website below. Sign up for my free newsletter. You become a free member of our real estate investing community. We have several thousand free members who continue to get educated and learn from our contents. And we've been doing it for several decades. I've been doing this in risk investing for a very long time. So thank you so much for watching. I'll see you next time. Have a nice day. Bye-bye.